2015's played out very much how we were expecting. At the start of the year we talked about markets being largely fully valued with a number of structural risks in the global economy which we expected heightened volatility to what we'd seen in recent years. And by and large that's what we've seen. Equity markets at the headline level have been flat to slightly negative returns as we look around the globe. Certain components of those markets, like emerging markets, have fallen precipitously. And you look at other things like commodity markets have fallen very, very strongly as well during the year. Currency markets have also shown some strong directional moves. In particular, the US dollar has showed continuing resurgence. But most broadly, volatility has really been something across all markets that we've seen. The ongoing slowing of the Chinese economy is something that has been prevalent as the country works very hard to shift from an export-driven economy to more a service, internal consumption-based economy. In addition to that, the first potential rate rise in 8 years is around the corner for the US Federal Reserve, and that's in the backdrop whilst countries regions like Japan and Europe continue to work very hard to pump liquidity into the system to ensure that their interest rate stays at what are historical lows. The volatility and the size of the falls we've seen in commodity markets is really noticeable. This is largely being driven out of emerging market demand, in particular China, but what's of biggest note really amongst that is the oil price fall. With oil currently sitting around $35 is going to have very, very large implications for global economies and certain components of those economies moving forward. Well, in 2015, year to date, we've seen the portfolios performing incredibly strongly given the array of market opportunities I've just spoken about. We've spoken to our clients at length about the fact that we don't just want to follow the herd, we don't just want to invest in standard industry options, and the performance in 2015 couldn't have showed this more clearly. What's most pleasing is our forecasts and our expectations about how markets and investment opportunities will play out have really come to fruition very clearly. Whilst equity markets have been flat to slightly down, we've actually made some very, very good money in equity investments, and this really comes down to the strength of stock selection. Similarly, currency has been something we've been talking about for some time, and the strength of the US dollar has contributed very well to the portfolios. The portfolios have actively been moved away in recent years from credit and fixed income markets, and again, the flat to negative returns seen in parts of these markets, us not being exposed, has shielded us from that negative impact. And finally, the alternatives component of our portfolio. These are typically non-traditional investments which aren't just equity or fixed income. There's a range of alternative investments that we make, and they again continue to contribute very positively, which is what we expect, that those returns aren't correlated to market cycles of equity or interest rate markets. We're actually expecting 2016 to be very similar to 2015. That is, at the headline level for markets, we're not expecting very material movements in a positive manner. And in addition, we're expecting volatility, spouts of volatility to come through. However, our approach is to find attractive investments across a range of different markets and a range of different factors. We continue to be very comfortable with how the portfolios are positioned and the array of different opportunities that are available to us in 2016.